Margin trading promises to turn $1,000 into $10,000. You put up $1,000. The exchange lends you $9,000 more. Now you control $10,000 worth of Bitcoin. It goes up 10%. You made $1,000 on a $1,000 investment. That's 100% return instead of 10%. Sounds incredible. Here's what happens when it goes wrong. Bitcoin drops 10%. Your $10,000 position is now worth $9,000. Your $1,000 of actual capital is gone. Liquidated. The exchange takes everything to cover their loan. You're left with nothing. One 10% move in the wrong direction. Complete wipeout. This isn't a rare edge case. This is what happens to 90% of margin traders. This video breaks down exactly how margin trading works, the math behind liquidations, why the deck is stacked completely against retail traders, and why the instrument designed to amplify gains almost always amplifies losses instead. Margin trading means trading with borrowed money. You deposit collateral. The exchange lends you additional capital based on that collateral. The ratio of your position size to your actual capital is called leverage. 10 times leverage means you control 10 times your actual capital. 100 times leverage means you control 100 times your actual capital. With 100 times leverage, a 1% price move against you wipes out your entire position. You're not just betting on direction. You're betting on direction within a very narrow price range. The exchange is always on the other side. They've already accounted for your liquidation in their risk models. You haven't. Simple example. Bitcoin is at $80,000. You have $1,000. You open a 10 times leveraged long position. You now control $10,000 worth of Bitcoin, 0.125 BTC. Your liquidation price is roughly $72,000, a 10% drop. If Bitcoin reaches $72,000, your position gets automatically closed. You lose your entire $1,000. The exchange keeps theirs. Now Bitcoin is at $80,000 and you try 20 times leverage. You control $20,000 worth of Bitcoin, 0.25 BTC. Your liquidation price is now $76,000, a 5% drop. Bitcoin drops 5% multiple times per week. You'd be liquidated on a completely normal price movement. Higher leverage means your liquidation price is closer to your entry. Normal volatility becomes a wipeout mechanism. Perpetual futures contracts, the most common margin trading instrument in crypto, charge a funding rate. Every 8 hours, traders pay or receive a small percentage based on market sentiment. When more people are long than short, longs pay shorts. When more people are short than long, shorts pay longs. During bull markets, when everyone is bullish and opening long positions, funding rates can reach 0.1% per 8 hours. That's 0.3% per day, 9% per month, 108% per year, just to hold a leveraged long position. You need Bitcoin to go up more than 108% in a year just to break even on a leveraged long held continuously. This hidden cost destroys long-term leveraged positions even when the direction is ultimately correct. Bitcoin's daily volatility averages 3% to 5%. On high volatility days, it can swing 10% to 15%. At 10 times leverage, a 10% swing wipes you out. At 20 times leverage, a 5% swing wipes you out. At 50 times leverage, a 2% swing wipes you out. Bitcoin moves 2% or more in a single day approximately 80% of the time. At 50 times leverage, 80% of days have the potential to liquidate you if you catch the move in the wrong direction. You're not trading Bitcoin's long-term trend, you're trying to survive Bitcoin's intraday noise with a liquidation price sitting inside that noise. The volatility that makes crypto exciting for long-term holders is the exact mechanism that destroys leveraged traders. When Bitcoin drops rapidly, liquidations cascade. Leveraged long positions get liquidated. Those liquidations create sell pressure. The sell pressure drops the price further. More liquidations trigger. More sell pressure. Price drops more. Mass liquidation event. These cascades are visible on-chain data. Bitcoin drops from $50,000 to $42,000 in hours. Not because of fundamental news. Because a cascade of leveraged long liquidations created a self-reinforcing sell spiral. Every trader who was long with leverage contributed to the price drop that liquidated them. You're not just exposed to market risk, you're exposed to the collective behavior of every other leveraged trader in the market simultaneously. When they panic, your position gets caught in the blast radius even if you did nothing wrong. Exchanges offering margin trading have profound structural advantages over you. They see all open positions. They know exactly where the clusters of liquidations are. They know that if Bitcoin drops to $77,500, there are $500 million in long liquidations waiting. They can see this data. You can't. This creates an obvious incentive. Price movements toward liquidation clusters generate massive fee income for exchanges from forced liquidations. Whether exchanges deliberately hunt these levels is debated. What's not debated is that exchanges can see where liquidations are clustered and that reaching those levels generates significant revenue for them. The term liquidation hunting exists because the pattern is observable and documented. Leverage doesn't just change your financial exposure, it changes your psychology in ways that guarantee worse decisions. Normal Bitcoin volatility feels manageable when you hold spot. A 10% drop hurts, but you hold through it. The same 10% drop when you're at 10 times leverage means liquidation is imminent. Your nervous system treats it as an emergency. You make panic decisions. You add more margin hoping to avoid liquidation. You hold beyond your risk tolerance. You close the position at exactly the wrong moment. The position that would have recovered if held becomes a locked-in loss because leverage forced a psychological reaction that spot exposure wouldn't have triggered. Leverage doesn't just amplify financial outcomes, it amplifies emotional responses in ways that make every decision worse. Let's run the numbers on leveraged trading over time. You start with $10,000. You use 5 times leverage on every trade. You win 55% of trades, which is better than most traders manage. Your average win is 2% of position size. Your average loss is 2% of position size. Over 100 trades, the math looks reasonable on paper. But leverage introduces ruin risk. One catastrophic move, a flash crash, a black swan event, a cascade liquidation, can wipe out your entire account regardless of your win rate. Even with a positive expected value strategy, leverage means that given enough trades, the probability of total ruin approaches 100%. Not might happen. Will happen given sufficient time. This is the mathematical reality of leveraged trading that no platform explains to you. Professional traders who use leverage successfully do things retail traders don't. They never use more than 2 times to 3 times leverage. They have strict position sizing rules that mean no single trade can wipe more than 1% to 2% of their capital. They trade with sophisticated risk management systems. They have deep market understanding from years of experience. They have psychological conditioning that prevents panic decisions. They understand funding rates, basis, and carry costs deeply. They treat trading as a business with explicit risk budgets, not as a gambling exercise. The gap between how professionals use leverage and how retail traders use leverage is enormous. When platforms offer 100 times leverage to retail traders, they're offering a tool that professionals don't use to people who don't have the skills to use it responsibly. Understanding exactly where your liquidation is before entering a trade is non-negotiable. Yet most retail traders using leverage can't calculate their liquidation price. The formula for a long position: liquidation price equals entry price times 1 minus 1 divided by leverage ratio plus maintenance margin. At 10 times leverage with 0.5% maintenance margin on a $80,000 Bitcoin entry, liquidation price equals $80,000 times 1 minus 0.1 plus 0.005 equals roughly $71,600. Know this number before you enter. If Bitcoin regularly trades $71,600 intraday and you're entering at $80,000 with 10 times leverage, you're almost certain to be liquidated before any meaningful upside plays out. Shorting with leverage introduces the short squeeze risk. You short Bitcoin at $80,000 expecting it to drop. Instead, it rises. At 10 times leverage, a 10% rise to $88,000 liquidates you. But before liquidation, your position is losing and you're tempted to hold. Bitcoin keeps rising to $90,000, then $95,000. Other shorts are liquidating. Their liquidations force buying. The buying drives Bitcoin higher. More shorts liquidate, more buying. The price rips higher specifically because leveraged shorts are being forced to buy back their positions to cover. Your short position contributed to the very price movement that destroyed you. The short squeeze is a feature of leverage markets, not a bug. It happens repeatedly and predictably. Studies across multiple exchanges and markets consistently show that approximately 90% of retail traders using leverage lose money over any 12-month period. This isn't opinion. It's documented across traditional futures markets, forex markets, and crypto markets. The mechanisms are consistent. Undercapitalization means position sizes are too large relative to capital. Over-leveraging means liquidation prices are within normal volatility ranges. Funding costs drain accounts even when direction is correct. Emotional decision-making leads to cutting winners short and letting losers run. Lack of risk management means one bad trade can eliminate months of gains. The rare 10% who profit consistently are almost uniformly professionals with genuine edges, sophisticated risk management, and years of experience. If you're reading this without those characteristics, you're statistically almost certain to be in the 90%. Exchanges offering 100 times leverage are not doing you a favor. They profit from every liquidation. They profit from funding rates. They profit from spreads. Their business model is optimized for trading volume and liquidations, not for your profitability. The educational content they provide on how to use leverage is not designed to make you profitable. It's designed to make you comfortable enough to deposit capital and start trading. The risk warnings required by regulators appear and disappear. The 100 times leverage button is front and center. When you're liquidated, a new trader takes your place and the cycle continues. Exchanges are casinos that have convinced their customers they're investment platforms. The house always wins because the structure guarantees it. Before entering any leveraged trade, calculate the full cost. Funding rate over expected holding period, exchange fees for opening and closing, slippage on entry and exit at your position size, the probability of liquidation given historical volatility, the opportunity cost of capital locked in the position. Most retail traders calculate none of these. They see a potential gain and enter. The costs alone often make leveraged trading a negative expected value activity before accounting for the directional risk. A trade that looks like it makes 20% on leverage might actually make 8% after all costs if held for a month. And if the direction is wrong even briefly before recovering, you're liquidated before seeing the recovery. If you choose to use leverage despite everything in this video, here are the minimum requirements for not being immediately destroyed. Never use more than 3 times leverage. Calculate your liquidation price before entering. Size positions so that your liquidation represents a maximum 5% loss of total portfolio. Set stop losses above your liquidation price so you exit before getting liquidated. Understand the funding rate and account for it in your profit calculation. Never add margin to a losing position to avoid liquidation. If you're approaching liquidation, accept the loss and exit. Never use leverage on money you can't afford to lose. These rules will make your leveraged trading significantly less profitable than the 100 times screenshots suggest. They will also mean you're still trading next year. Bitcoin. Buy it, hold it in self-custody, no leverage, no funding rates, no liquidation prices, no cascading liquidations, no exchange risk. If Bitcoin goes up 50%, your holdings go up 50%. If Bitcoin drops 30%, your holdings drop 30% and you hold through it because no one can force you to sell. This strategy has outperformed the vast majority of leveraged traders over any 3 to 5 year period, not because it's clever, because it avoids all the mechanisms that destroy leveraged accounts while capturing the underlying asset's appreciation. Leverage makes simple things complicated and expensive. Self-custody spot Bitcoin makes complex things simple. One of these approaches builds wealth, the other one destroys it. Comment, got liquidated, if margin trading has cost you real money, or never touching it, if this video kept you away from leverage. Next video. I'm breaking down crypto VC investing, how venture capital funds dump on retail every single time, and why the projects with the biggest backers almost always hurt ordinary investors the most. Subscribe to Unbanked. The old money had a head start. You have the internet.